Welcome to this lesson on support and resistance, two of the most fundamental concepts in crypto trading. These key price levels help traders understand where the market is likely to reverse or pause. By mastering support and resistance, you will be able to make more informed trading decisions and identify strategic entry and exit points. Throughout this lesson, we will explore what these levels are, how to identify them, and how to use them effectively in your trading strategy. Support is a price level where buying pressure becomes strong enough to prevent the price from falling further. Think of it as a floor that holds the price up. When the price drops to a support level, traders perceive the asset as undervalued and start buying, creating demand that exceeds supply. This increased buying activity pushes the price back up. Support levels are psychologically important because traders remember these price points from past market behavior, and they anticipate that the price will bounce off this level again. Resistance is the opposite of support. It is a price level where selling pressure becomes strong enough to prevent the price from rising further. You can think of resistance as a ceiling that caps upward price movement. When the price approaches a resistance level, traders view the asset as overvalued and begin selling, creating supply that exceeds demand. This selling pressure forces the price back down. Like support, resistance levels are significant because market participants remember these price points and expect the price to reverse when it reaches them. There are several methods to identify support and resistance levels on a price chart. First, look at historical highs and lows. Price levels where the market has previously reversed multiple times often become significant support or resistance zones. Second, round numbers such as $50,000 or $100 frequently act as psychological levels because traders tend to place orders around these numbers. Third, trend lines can help identify dynamic support and resistance by connecting consecutive highs or lows in a trending market. Finally, volume clusters, or areas where high trading volume has occurred, often become important price levels as they represent zones where many traders have entered positions. One of the most interesting characteristics of support and resistance is that these levels can reverse their roles when broken. When a support level is broken and the price falls below it, that former support often becomes a new resistance level. Conversely, when a resistance level is broken and the price rises above it, that former resistance typically becomes a new support level. This phenomenon occurs because traders remember these price levels and adjust their behavior accordingly. For example, traders who miss selling at resistance may wait for the price to return to that level to sell, turning the old resistance into new support after a breakout. Support and resistance levels can be used in several trading strategies. The first strategy is to buy at support. When the price approaches a support level, traders enter long positions expecting the price to bounce upward. The second strategy is to sell at resistance. When the price approaches a resistance level, traders enter short positions anticipating a reversal downward. The third strategy is breakout trading. In this approach, traders wait for the price to break through a key support or resistance level with strong volume, then enter a position in the direction of the breakout. Each of these strategies requires confirmation through volume analysis and other technical indicators to increase the probability of success. When working with support and resistance, there are several important factors to keep in mind. First, these levels are better viewed as zones rather than exact price points. Prices rarely stop at the exact same level every time, so it is more practical to identify a range where support or resistance exists. Second, the strength of a level increases with multiple touches. The more times a price level is tested without breaking, the more significant that level becomes. However, repeated tests can also weaken the level over time. Third, the timeframe matters significantly. Support and resistance levels identified on higher timeframes, such as daily or weekly charts, are typically more reliable and significant than those on lower timeframes like 1-hour or 15-minute charts. Let us recap the key concepts from this lesson. Support acts as a floor where buying pressure prevents the price from declining further. Resistance acts as a ceiling where selling pressure prevents the price from rising higher. When these critical levels are broken, they often reverse roles, with former support becoming resistance and former resistance becoming support. By identifying and understanding these levels, you can use them to determine strategic entry and exit points for your trades. Mastering support and resistance is essential for improving your trading decisions and managing risk effectively in the crypto market. Practice identifying these levels on real charts to develop your skills and confidence.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.